Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, $100 billion India EFTA trade deal pioneers an investment for access model, setting a precedent for major negotiations with the UK and European Union. So we'll discuss why this deal signals India's Europe pivot and what it means for Western firms seeking a China plus one alternative. Second, Supreme Court halts Trump's firing of Fed Governor Cook, setting up a historic clash over Federal Reserve independence and presidential power. We'll examine how this unprecedented political fight erodes market confidence, potentially creating a risk premium on US assets and destabilizing global monetary policy. Third, with Caribbean insurance premiums surging 40%, the market's collapse is fueling a sovereign debt crisis and a boom in catastrophe bonds. This discussion will reveal how the failure of traditional insurance intersects with sovereign debt risk and what this means for investors in this new asset class. A new trade deal just went live, centered on a massive number, $100 billion in investment and a promise of 1 million new jobs over the next 15 years. India has officially activated its landmark agreement with the European Free Trade Association, a bloc including Switzerland, Norway, Iceland, and Liechtenstein. On the surface, this means India will slash tariffs on up to 85% of goods from these nations, making products like Swiss chocolates and wines cheaper for consumers. Now, you might think cheaper Swiss chocolates and wines are just a small consumer perk, but economists see it as something much more significant, a real-world test. The price drops will create a small but measurable disinflationary effect in specific categories of the Consumer Price Index, or CPI. The reason that's so important is that the CPI is a key lagging indicator of inflation. By watching how these tariff cuts play out, we get a preview of the potential price dampening effects from the much larger trade deals India is currently negotiating. In return, Indian exporters get duty-free access to 99% of EFTA markets. But that's not the whole picture. The real turning point isn't about tariffs at all. This is India's first ever trade agreement where market access is directly tied to massive investment pledges. This fundamentally changes the negotiation. The model is what experts call an investment for access agreement. Essentially, this EFTA deal is seen as a leading indicator, a template for India's much larger ongoing negotiations with the UK and the European Union. If successful, this could dramatically accelerate foreign direct investment into India, but it also introduces new risks if partners feel the demands are too high. It signals a strategic shift in how global trade deals are negotiated, with capital commitments now becoming a core demand, not just an afterthought. But it's not exactly a simple win for Indian exporters. Interestingly enough, according to the Global Trade Research Initiative, most of India's industrial goods already had zero duty access to these markets, meaning the immediate tariff benefits are minimal. In fact, this minimal impact on trade seems to be by design. Here's where it gets interesting. The single largest import item from the EFTA bloc, Swiss gold, is specifically excluded from this deal. In recent years, gold has accounted for up to 80% of India's imports from Switzerland. By excluding it, the deal ensures that India's large trade deficit with the bloc won't change much overnight. This is a huge clue. It tells us the agreement was never about correcting short-term trade imbalances. It's about strategic signalling and attracting very specific long-term investments in sectors like manufacturing and pharmaceuticals. The analyst states the real gain isn't from tariffs but from perception building. This perception is being built against a tense global backdrop. The deal comes as India faces steep 50% tariffs from the United States and is simultaneously negotiating separate trade agreements with the UK and the European Union. So the deal is a cornerstone of India's Europe pivot, which is directly linked to the global China plus one strategy. For a Chinese-speaking audience, the implication is significant. As some international companies seek to diversify their supply chains beyond China to reduce risks from geopolitical tensions, India is aggressively positioning itself as the most stable and attractive alternative. By locking in long-term investment and trade with stable European economies, India is solidifying its appeal to Western firms looking for their plus one manufacturing and sourcing hub. This isn't just a deal, it's a strategic message. So while the headlines may focus on consumer goods, the real move is on the global chessboard. India just used a $100 billion commitment to rewrite the playbook for international trade, forcing partners to put serious capital on the table and signalling a major pivot in its economic strategy. Looking ahead, we should watch two things. First, whether the UK and EU accept this investment for access model in their own talks with India. Second, keep an eye on foreign direct investment flows into India, especially in the pharmaceutical sector, where this deal creates a powerful synergy between Indian generic manufacturing and Swiss pharma R&D. These will be the true indicators of whether India's bold new playbook is a success. Speaking of major economic strategies, a power struggle back in the US is threatening to destabilize the very institution that steers its economy. A battle for control of America's central bank has just landed on the steps of the Supreme Court. We've been flagging that mounting political pressure on the Fed was no longer theoretical, and today it's literally before the justices. The court has temporarily blocked President Donald Trump's historic attempt to fire Federal Reserve Governor Lisa Cook. This is a major setback for the president, who is in an open fight with the institution over interest rates. No president has ever tried to remove a Fed governor before, and the move has sent shockwaves through Washington and Wall Street. We previously analysed how this pressure was building. The latest development is that the court has pressed pause and will hear full arguments in January. The stakes here are incredibly high because the Federal Reserve's independence is the very cornerstone of its ability to control inflation and maintain long-term economic stability. The idea is to prevent politicians from making short-sighted decisions, like juicing the economy right before an election, that could lead to disaster later. The history is instructive. In the 1970s, President Nixon pressured Fed Chairman Arthur Burns to keep interest rates low, which contributed to the runaway inflation of that decade, a period now known as the Great Inflation. The situation presents a fascinating duality. President Trump claims he fired Cook over allegations of mortgage fraud, which she denies. But Cook, a Biden appointee, immediately sued, arguing the firing is illegal political interference. She contends the real reason is her stance on monetary policy, a direct challenge to the Fed's long-held independence. And this very public fight is what erodes the market's perception of the Fed's autonomy. Now get this, that perception shift can create what's called a political risk premium on US assets. In simple terms, investors will demand higher interest rates on US government bonds to compensate for the added uncertainty, which can make borrowing more expensive for everyone. Layer onto that, a risk we discussed earlier. If inflation proves sticky, markets may have to rapidly reprice, hitting rate-sensitive tech stocks and long-dated treasuries, amplifying any political risk premium. However, if you zoom out, you'll see another layer to this. The law states a governor can only be removed for cause, but that term has never been legally defined. So this showdown is forcing a definition. The timing is critical, as the Supreme Court's decision on what for cause means will set a massive precedent. The standard comes from a 1935 case, Humphreys Executive v. United States, which established that heads of independent agencies couldn't be fired at the president's whim. If the court broadens the president's power now, it could damage the Fed's credibility for years to come. The risk is that it might unanchor inflation expectations, meaning people and markets start to believe the Fed can't or won't control inflation, forcing the central bank to use even more aggressive rate hikes in the future to prove its resolve. That echoes a warning we covered a while back. If a president is perceived as being in control of the Fed, its ability to make painful but necessary decisions is fundamentally compromised. The Supreme Court's ruling means Cook stays in her role for now and will vote on interest rates at least 2 more times. This comes as the Fed recently made its first rate cut in nearly a year, despite what Chairman Jerome Powell insists was not a response to political pressure. So the fight over one governor's seat has a direct impact on the Fed's internal balance. The board is made up of members with different views. Some are doves who favour lower rates to boost growth, while others are hawks who prioritise higher rates to fight inflation. Every vote matters, and the outcome of this fight could shift the board's centre of gravity, directly affecting the timing and size of future interest rate changes that markets are trying to price in. As we noted a while back, dovish dissents at the Fed are historically rare, another reason a single vote can meaningfully change the signal the market hears. The Trump administration has already taken the highly unusual step of appointing a White House economic advisor to temporarily fill another vacancy on the Fed board. Now, all eyes are on January when the Supreme Court will hear full arguments. Believe it or not, the implications go far beyond America's borders. A high-profile challenge to the independence of the US, Federal Reserve could embolden political actors in other major economies like the European Union or the United Kingdom to pressure their own central banks. This threatens a global wave of policy miscoordination, which could increase currency volatility. For a major trading nation like China, this matters because it could create instability in the exchange rates between the yuan, the dollar, and the euro, directly impacting trade dynamics. This case is no longer just about one governor's job. It's a high-stakes confrontation that could redefine the power of the White House over the US economy. This January, the Supreme Court won't just be ruling on one person's position. It will be drawing the line between presidential power and the independence of America's central bank. From a political risk, shaking one of the world's most stable financial institutions, we now turn to a climate risk that's causing an entire market to collapse in the Caribbean. In the Caribbean, home insurance premiums are surging by as much as 40%. But this isn't just a price hike. It's a market on the brink of collapse, leaving an entire region financially exposed as hurricane season hits its peak. The crisis is fueled by a perfect storm of intensifying cyclones and small populations, creating a risk profile that insurance companies are fleeing. The numbers are staggering. In Jamaica, an astonishing 80% of homes have no coverage at all. In Barbados, just half are insured. Many residents are forced to build homes out of pocket and simply hope for the best, with one Barbudan calling insurance just an added expense to the meagre resources we have. And this isn't just a problem for homeowners, it quickly becomes a national crisis. When private insurance disappears, the massive cost of rebuilding after a hurricane falls directly onto the government's shoulders. This is where the situation takes a more complex turn. For these small island nations, a major climate disaster can trigger a sovereign debt crisis. You see, international rating agencies are now watching climate vulnerability closely. Research from the IMF shows that a 10 percentage point increase in a country's climate vulnerability can raise its government borrowing cost by 30 basis points. For developing economies, it's even worse, potentially over 150 basis points. It creates a vicious cycle. A country hit by a storm not only has to pay for rebuilding, but also faces higher interest rates on all its debt. To understand the scale of this financial disconnect, consider this. A typical home insurance premium in Antigua can run between 1.3 and 1.7% of the property's value. In a market like the United Kingdom, it can be less than 0.2%. That's a nearly tenfold difference, making protection prohibitively expensive for millions. And the consequences are massive. After Hurricane Irma, the cost to rebuild the island of Barbuda alone topped $200 million, forcing the nation to rely on international aid from the UN, China, and the European Union. The mention of China here is particularly important, and it's not just about simple charity. What really brought this to a head was the rise of what experts call disaster diplomacy. This is a key part of China's soft power strategy. By providing aid and infrastructure investment, often linked to its Belt and Road Initiative, China can build long-term strategic influence in a region historically close to the US and Europe. For Chinese-speaking audiences, the implication is that this creates new opportunities for Chinese enterprises in infrastructure and construction abroad, but it also intertwines China's finances with the stability of these climate-vulnerable nations. What's more, even with aid money, rebuilding is not straightforward. The massive sudden demand for construction materials and labour in a small market creates what economists call climate resilience inflation. In the Caribbean, construction costs have already surged by an average of over 19% in just 2 years. This means that $200 million in aid doesn't actually buy $200 million worth of rebuilding. Its value is eroded by soaring prices. This isn't just about rising costs, it's about escalating danger. A director of disaster services warns, these days, storms can go from a category 1 to 5 in a day. The new norm has thrown out the old regiment. Even regional backstops are showing the strain, with one catastrophe risk facility making record payouts of over $85 million last year alone. So we're seeing climate events become more extreme, while at the same time, the financial mechanisms designed to protect against them are breaking. So what's on the horizon? The answer seems to lie in financial market innovation. The failure of traditional insurance is forcing a search for alternatives. And one of the most important to watch is the catastrophe bond, or cat bond. Instead of an insurance company taking the risk, it's packaged into a bond and sold to investors in the global capital markets. If no major disaster hits, investors get a nice return. But if a predefined catastrophe happens, investors lose their principal and that money is used to pay for the damages. The real significance is that it's a way to bring Wall Street's deep pockets to bear on climate risk. And it's not a niche idea anymore. The market for these cat bonds is exploding, with a record-breaking $18.6 billion issued so far this year. The focal point to watch is whether this new market can grow fast enough to fill the massive gap left by traditional insurance. The result is a region facing a new kind of storm, a financial one, where the cost of protection is becoming as devastating as the disaster itself.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.